Let's say you get a phone call today, and it's an estate attorney.
Right, telling you that a relative has passed away and left you an IRA.
Yeah, exactly. And, after the initial shock and the grief settle down, you might think, well, at least I have this financial cushion now.
Sure, that's a natural reaction.
But here is the million-dollar question, literally, in some cases. If you suddenly inherited an IRA today, would you know how to avoid handing a huge chunk of it right back to the IRS?
Most people wouldn't. They assume an inheritance is just a clean, simple transfer of wealth.
Like getting a house or a standard bank account.
Exactly. But the reality of inheriting a retirement account is completely different. It is arguably the ultimate trapdoor in personal finance.
Because the instincts that usually serve you well in normal saving and investing, they actually penalize you here.
They really do. It's counterintuitive.
So that's exactly what we are unpacking in this deep dive. We're pulling from the essential guide to inherited IRA tax rules to guide you through this complex, often super confusing maze of tax rules so you don't accidentally trigger massive penalties.
And there is a very surprising reality at the core of all this, right off the bat.
Yeah, the act of inheriting the account balance itself, that's actually entirely tax-free under current law.
Right. The government doesn't tax you just for having your name added to the account as the beneficiary.
So the inheritance isn't the taxable event at all.
No, not at all. The trap lies entirely in how and when you withdraw those funds.
Like the moment a single dollar leaves the protective shell of that account, the IRS is watching under a microscope.
Exactly. But before you can even formulate a strategy for taking the money out, you have to understand the specific DNA of the account you've just inherited.
Okay, let's unpack this. I like to think of IRAs like two different doors at the tax office.
Well, that's a great way to picture it.
Yeah, so the traditional door means the original owner got a tax break on the way in. Like they didn't pay taxes on that money when they earned it. So you, the inheritor, have to pay the cover charge on the way out.
Right. And the Roth door means the original owner paid taxes up front. So you get to walk out tax-free.
It all comes down to whether the IRS has gotten their cut yet.
Let's look at the exact mechanics behind that traditional door first. Traditional IRAs grow tax-deferred.
Meaning all the compounding interest, the dividends, capital gains, none of that is taxed while sitting inside the account.
Right. But the IRS is incredibly patient. They eventually want their revenue. Any amount you withdraw from an inherited traditional IRA is taxed at your regular income tax rate.
In the year you make the withdrawal.
Exactly.
So, okay, if you're currently making, say, $100,000 a year at your job, and you pull out $50,000 from this inherited traditional IRA to pay off a mortgage or something.
The IRS treats you as if you earned $150,000 that year.
Wow. It just stacks directly on top of your salary.
It does. Which easily puts you into a much higher tax bracket, costing you way more than you anticipated.
And just to add a layer of complexity here.
There's always another layer.
Always.
Yeah.
If the original owner made both deductible and non-deductible contributions to that traditional IRA over their lifetime, part of each distribution you take is taxable, and part of it is a non-taxable return of their basis.
Which is an absolute accounting nightmare to track.
Totally. Now, walking through the Roth door sounds like the ultimate dream scenario. The taxes were already paid by the deceased, so you can withdraw those original contributions tax-free at any time.
Mostly, yes.
But wait, I need to challenge the logic on the next part of this. If the government already got their tax revenues when the original owner put the money into the Roth, why do they care what I do with it?
What do you mean?
Like they aren't losing any tax revenue if I just leave it in there forever, right?
You would think so, but they are losing out on the tax revenue from the future growth of those assets.
Oh, right, because all that growth is tax-free.
Exactly. The government essentially views that tax-free growth as a massive subsidy. They're willing to give that subsidy to the person who funded the account to encourage retirement savings.
But they draw the line at letting an heir compound tax-free wealth indefinitely.
Precisely. They want that protective tax-free wrapper ripped off the money.
And they enforce that with a very specific caveat.
Yeah, for the earnings in an inherited Roth IRA to be tax-free and penalty-free, 5 years must have passed since the original owner's first contribution.
Right, any Roth IRA.
Right, any Roth. And the new owner has to be 59 and a half or older.
So even with a Roth, you can't just blindly liquidate the account without checking the calendar first.
Definitely not.
Speaking of that protective wrapper, there was a fast fact in the source that really surprised me. The actual asset inside the wrapper almost doesn't matter anymore.
Not at all.
We usually think of IRAs holding mutual funds or treasury bonds. But the wrapper has evolved. We're now seeing self-directed IRAs holding alternative assets.
Yeah.
Like you can literally have a Bitcoin IRA.
Oh, yeah, using that exact same tax advantage wrapper to invest in cryptocurrency. The underlying asset could be an S&P 500 index fund, real estate, or Bitcoin. The IRS doesn't differentiate.
The tax wrapper surrounding the asset dictates the timeline and the taxation.
Exactly.
So we have the DNA figured out. We know if the money is pre-tax or post-tax. But the moment you walk through either of those doors at the tax office, you run into a bouncer checking your ID.
Because the rules drastically shift based on exactly who you are in relation to the deceased.
This is the most critical fork in the road for anyone inheriting an IRA today.
It really is, and it all stems from a massive legislative shift. The Secure Act of 2019 completely rewrote the rulebook. It created two vastly different realities for spouses versus non-spouses.
Let's talk about what things looked like before 2019, because it explains why the government clamped down so hard.
Right. Before the Secure Act, a non-spouse beneficiary, say, a 30-year-old inheriting an IRA from their parent, could execute what financial planners called a stretch IRA.
They could stretch the required withdrawals over their entire statistical life expectancy.
Exactly. Taking tiny microscopic distributions each year and letting the bulk of that money compound tax-free or tax-deferred for 5 or 6 decades.
It was essentially a government-sanctioned generational wealth-building machine. You pass down a massive portfolio and let it snowball for another half-century.
And the government realized they were deferring massive amounts of tax revenue across multiple generations. What's fascinating here is how they fixed it.
They just killed it.
Yeah. For anyone inheriting from an owner who died after January 1st, 2020, the Secure Act effectively killed the stretch IRA for most non-spouses.
Instead of a lifetime to drain the account, you are now placed on a strict 10-year clock.
You must withdraw the entire balance of the inherited IRA by December 31st of the 10th year following the original owner's death.
Wait, so if I inherit an IRA from a parent, the government essentially forces me to drain the account and pay taxes on it within a decade. I can't just leave it in there to grow.
Nope. 10 years and the account must hit zero.
That is an incredibly tight window if you're inheriting a large sum and trying to avoid spiking your own income tax brackets.
It is a deliberate forcing mechanism. Now, the bouncer at the tax office does have a VIP list.
Oh, right.
The law created a category called eligible designated beneficiaries who are exempt from this strict 10-year rule and can still stretch their distributions.
Okay, who gets onto that VIP list?
There are 4 main groups. Individuals who are chronically ill or disabled are exempt. Minor children of the deceased get the exception, but only until they reach the age of majority.
And at that point, their 10-year clock starts ticking.
Exactly. An individual who is not more than 10 years younger than the IRA owner, like a sibling or an unmarried partner, is also exempt.
But the most powerful VIP status belongs to the surviving spouse.
Without a doubt, spouses get incredible flexibility here.
It's almost like they get to choose their own adventure, whereas a non-spouse is treated like a totally separate entity.
If a spouse inherits an IRA, they have options no one else has. The most common move is to simply take the funds and roll them over into their own pre-existing IRA within 60 days.
They just absorb the money.
Right. They treat the inherited IRA entirely as their own, which delays any required withdrawals until they reach the mandatory age themselves. Or they can remain the beneficiary, but base the required distributions on their own life expectancy.
They absorb the account into their own financial life. But for the non-spouse on that 10-year clock, the government enforces that timeline through a mechanism called required minimum distributions, or RMDs.
And failing to understand RMDs is the single most expensive mistake you can make.
Because the RMD is the government's way of systematically forcing the money out of the wrapper.
This raises an important question. When exactly do you have to start taking this money? The rules here have been a moving target recently.
Yeah, the Secure Act 2.0, which passed in 2023, changed the starting line again.
As of January 1st, 2023, original owners of traditional IRAs must begin taking RMDs at age 73.
It used to be 72, and before that, 70 and a half. So they're pushing it back, giving people a little more time to let it grow.
And it's scheduled to increase again to age 75 in 2033.
But we need to revisit our Roth door for a second here, because there's a trap that catches people completely off guard.
Yes, Roth IRAs are totally exempt from RMDs for the original owner. You can leave the money in a Roth until the day you die, and the IRS won't ask for a dime.
But they're not exempt for the inheritor.
No, they aren't.
Wait, if the IRS isn't getting any income tax revenue from the Roth withdrawal anyway, since it's tax-free, why force you to empty the account?
It goes back to that tax-free growth subsidy. They don't want you hoarding an asset that is generating tax-free dividends and capital gains for another decade.
So they force you to pull it out so that any future growth happens in a regular taxable brokerage account.
Exactly. You generally have to take RMDs or adhere to the 10-year rule, even though the withdrawals themselves aren't adding to your tax bill.
Okay, so if you are caught in the RMD net, how do you even calculate what you owe? It's not like the IRS just sends you a clean invoice every January.
Oh, no. You have to do the math yourself or have your custodian do it. There is a specific 3-step calculation for the year the owner died, assuming they were supposed to take an RMD but hadn't yet.
Okay, what's step 1?
Step 1, you find the IRA's balance on December 31st of the previous year.
Makes sense. Start with the baseline.
Step 2, you locate the distribution period from the IRS's single life expectancy table, known as Table 1. This is based on the account owner's age on their birthday and the year of their death.
And step 3.
You divide the balance from Step 1 by the statistical life expectancy factor from Step 2.
Let's break down the logic of that IRS Table 1, because it's essentially the IRS acting as an actuary.
They are making a statistical bet.
Yeah, they want to guarantee they extract all the tax revenue before you die, but they don't want to force you to take 50% of the account in 1 year, which would basically bankrupt you in taxes.
Right. They use the life expectancy table to smooth out the required withdrawals over your statistical lifespan. It is a calculated revenue extraction.
Here's where it gets really interesting, though, the penalty trap.
You do not want to mess up that calculation, because if you forget to take an RMD or you just do the math wrong and take too little, the IRS hits you with a massive penalty.
It's currently a 25% penalty on the amount you were supposed to withdraw but didn't, right?
Yes, a quarter of the required distribution instantly vaporized as a fine.
Not as taxes, but as a penalty on top of the taxes you still owe.
It's extremely punitive. Now, they will reduce that penalty to 10% if you fix a mistake within a specific correction window.
When is the window?
It begins on the date the penalty is imposed, usually January 1st of the year after you miss the deadline, and it ends on the earliest of 3 dates.
Okay.
The date the IRS mails you a notice of deficiency, the date they officially assess the penalty against you, or the last day of the second taxable year after the penalty is imposed.
So they give you a slight reprieve to fix the accounting error, but you have to be incredibly proactive.
The irony is that the IRS itself has struggled to interpret these rules.
Yeah. Following the original Secure Act, the new 10-year rule, combined with RMD requirements, was so confusing that the IRS actually had to officially waive penalties for missed RMDs in 2021 and 2022.
Nobody, not even the custodians, knew exactly what the beneficiaries were supposed to be doing.
When the agency enforcing the rules admits the rules are too confusing to penalize people for breaking them, you know you're dealing with an administrative gauntlet.
Absolutely.
Which brings us to the actual execution of this process. Knowing the math and the deadlines is only half the battle. If you stumble on the paperwork, you trigger the taxes anyway. Let's look at a major pitfall we can call the name tag trap.
This is a big word.
Let's say you're a non-spouse, you inherit an IRA, and you walk into the bank and say, hey, please transfer this account into my name.
That simple phrase is a catastrophic error. If a non-spouse beneficiary puts an inherited IRA directly into their own name, the IRS views that as a complete 100% lump sum distribution.
The protective wrapper is instantly destroyed.
You drain the entire account in 1 second, and you owe regular income tax on the entire balance for that tax year.
Ouch. You have to establish a brand new inherited account, and the title of that account must conform to exact IRS specifications.
It must explicitly identify the deceased owner, state that they are deceased, and identify you as the beneficiary.
The formatting usually looks something like the owner's name, deceased date, IRA, FBO your name, beneficiary.
Right, FBO meaning for the benefit of. And the structure of the accounts is just as crucial when dealing with multiple beneficiaries.
Right. Imagine an IRA is left 50-50 to a surviving spouse and a child from a previous marriage.
As we established, the spouse has that VIP pass incredible flexibility to delay distributions. The child is locked into the strict 10-year clock.
So, if they leave all that money pooled together in a single inherited account, whose rules apply?
That is the regulatory nightmare. If the account isn't handled correctly, the spouse could lose their VIP privileges and get dragged onto the 10-year clock.
So how do you fix it? Splitting the account.
Exactly. They can legally divide the original IRA into separate, distinct accounts for each beneficiary. But the deadline is absolute.
The split must be finalized by December 31st of the year following the original owner's death.
By isolating the funds, the spouse protects their special tax privileges, and the child manages their own 10-year timeline independently.
So what does this all mean for a listener who doesn't actually need the RMD money and wants to avoid the income tax hit entirely?
Yeah.
Like, say you are that child, you're stuck on the 10-year clock, but you're already financially secure.
Right, you're in your peak earning years, high tax bracket.
And the last thing you want is forced taxable income.
If we connect this to the bigger picture, there is a remarkably elegant strategy here, assuming you meet the age requirement. It ties back to broader estate planning and philanthropy. It's called the Qualified Charitable Distribution, or QCD.
How does that work?
If you are 70 and a half or older, you can instruct your IRA custodian to transfer money directly from the inherited IRA to a qualified public charity.
The mechanism is what makes this so powerful.
Yeah.
Because the money goes directly from the IRA to the charity, it never touches your personal bank account.
Exactly. It completely bypasses your adjusted gross income.
It never shows up on your tax return as taxable income, which means it can't push you into a higher tax bracket or trigger surcharges on your Medicare premiums.
The tax burden is neutralized, and the limits on this are incredibly generous. Utilizing a QCD satisfies your required minimum distribution for the year.
So for the 2025 tax year, you can transfer up to $105,000 completely tax-free.
And in 2026, that limit bumps up to $111,000. It transforms a forced tax liability into a massive philanthropic tool.
But whether you donate the money, stretch it out, or take it as cash, there is a trail of IRS paperwork that follows every move.
Always. When you take a distribution from a traditional IRA, the custodian is going to generate IRS Form 1099-R.
Form 1099-R is the receipt the IRS gets showing exactly how much left the wrapper. You have to reconcile that form on your personal tax return.
And there is a default setting on these distributions that catches beneficiaries off guard. These RMDs are categorized as non-periodic distributions, meaning they are subject to an automatic 10% federal tax withholding by default.
Meaning the bank automatically chops off 10% and sends it to the IRS before the money even hits your checking account.
Yep.
If you want the full amount and plan to pay the taxes out of pocket later, you have to proactively file IRS Form W4R to opt out of that automatic withholding.
Which brings us to one final, highly specific tax maneuver. It applies to a narrow subset of people, but if you fall into this category, the financial impact is enormous.
Let's hear it.
If the original owner of the IRA died with a massive estate large enough to trigger federal estate taxes and thus estate taxes were paid, the beneficiary inheriting the IRA might be entitled to a specific tax break.
The miscellaneous itemized deduction.
Right, because the money in the traditional IRA was technically counted as part of the deceased's total estate value, federal estate taxes were calculated based on it.
But when you withdraw that IRA money, you are paying income tax on it.
To prevent the same dollars from being severely double taxed, once by the estate tax and once by your income tax, the IRS allows the beneficiary to take a miscellaneous itemized deduction for the exact portion of the federal estate taxes allocable to that specific IRA distribution.
So if you inherit a $1 million IRA from an ultra-high net worth estate that already paid millions in federal estate tax, you don't just blindly pay the income tax on your withdrawal.
No, you work with a CPA to calculate the exact ratio of the estate tax tied to your inherited million, and you deduct that against your own income taxes.
It requires you to itemize your deductions rather than taking the standard deduction. And the math is highly complex, but the tax savings can completely offset the burden of the inheritance.
It's huge.
It's all about understanding the levers available to you. Inheriting an IRA means navigating a labyrinth of mandatory withdrawals, strict Secure Act deadlines, and severe RMD penalties.
The biggest takeaway from everything we've uncovered today is simple. Do not act blindly.
The moment you move that money without understanding the tax DNA, or whether you have the spousal VIP pass or are locked into the 10-year clock, you risk surrendering a huge portion of that wealth back to the government.
The regulatory framework dictates the timeline you have to work with, but you still retain the power to dictate the strategy within that timeline.
Which brings us to a final thought I want to leave you with. When you look at that 10-year rule for non-spouses, it feels entirely like a burden. The IRS is demanding their cut within a decade.
But you don't have to take equal, predictable amounts every single year. You have complete control over the throttle.
What if you strategically mapped out the next decade of your life? Let's say you were planning to take a sabbatical or launch a startup, or you were aiming for early retirement in 5 years. You know there is a year coming up where your regular earned income is going to drop significantly, maybe even to zero,
Right, if you hold back on your IRA distributions while your salary is high,
and then pull massive distributions during that gap year when your income is zero, you are effectively absorbing the inheritance at the absolute lowest possible tax bracket.
you are using the government's 10-year window to smooth your income perfectly.
Takes a strict, intimidating IRS deadline and turns it into a decade-long tax planning superpower.
It really does.
So if that estate attorney calls you tomorrow, don't just react to the IRS's rules. Look at the calendar, look at your own financial trajectory, and use the structure of the inherited IRA to make sure you keep exactly what is yours.